Welcome to Retiring Well. Listen, folks, we've got a great show for you today. I'm going to be talking about safe withdrawal rates, the US dollar index, why do we watch that, fees and commissions, rental income and how it can be particularly a nice asset to have in retirement, and then maybe some things that you haven't thought of when it comes to life insurance. So stay tuned.
Retiring Well, brought to you by Centennial Wealth Advisory, financial advisors specializing in retirement planning and serving all of northern Michigan. Retiring Well, helping you plan for a successful and comfortable retirement. Retiring Well, plan to retire well.
I want to talk in this segment about what we call the safe withdrawal rate, okay? Now, what this is the concept is simply this. It's an amount or percentage of a portfolio that you can take from that is considered safe in the sense that you're not going to run out of money. You might even grow your principal a little bit over time. Okay, so it's not brain surgery, all right? If I got a portfolio that's making 5, 6, 7% on average, and I'm pulling 4, 5% out, maybe that's what I've deemed a safe withdrawal rate, then that works all day long, right? Because I got 5, 6, 7% pulling 4 or 5% out. That plan's going to work forever, right? Now, that's the concept, but you have to understand, you're going to want to make sure that you don't have any big losses in that picture. Remember, that concept only works if you're averaging that as a rate of return with no hiccups. Now, let me give you a case where this can be bad. Let's say I got a portfolio that's maybe, let's say just $500,000, just so we use a round number, and I'm pulling 5% off. So now I'm taking $25,000 a year for income, okay? As long as that portfolio continues to make 5% or more, I'm good, right? But what if we have like a 2008 and that portfolio drops to half its value? If I needed that $25,000 for income and now my account's only worth $250,000 and I'm pulling out $25,000, folks, you're now pulling out 10%. Now, how do I grow it back? I've got to get a better than 10% rate of return from here on out just to even start building that portfolio back up. So you want to understand that that concept works, but you're not going to have any big losses. It used to be that when you got close to retirement or in retirement, you were in what you call the preservation of wealth and income phase of your life. Most would just move from equities into fixed income accounts like bonds when they were paying, let's say, 5, 6, 7% or more. Today, the yield on bonds is so low, it's hard to make that move without having a mix of stocks in there. And of course, with stocks or equities, there's risk. So you want to be well diversified, you want to be positioned accordingly. Be careful of those income plans out there. There's a lot of income plans. All advisors have the tools. They'll tell you that you're never going to run out. But remember that one assumption is that rate of return they put in there, that growth rate is going to be consistent. And sometimes that doesn't happen. All right, remember in retirement, your number one enemy is going to be volatility, as I explained earlier. So be careful. Hi, my name is Larry Flynn. I'm a financial advisor, senior partner here at Centennial Wealth Advisory. Listen, with this coronavirus, it created unprecedented times. High unemployment, you got a lot of businesses not reopening. Whether there comes a treatment or a vaccine for this disease, we don't know. There's just a lot of questions, a lot of uncertainty. But your financial well-being is still very important. And if you're in retirement or near retirement, then getting some good, sound financial advice is going to be critical. So in these unprecedented times, we're understanding that safety is a concern, and so we're offering a couple options. If you're willing to talk by phone or want to do a virtual meeting, whether that be Zoom or something like that, we're offering that ability to do that. If you're somebody that does want to meet in person, we're trying to accommodate that as well. We're saying, we're not going to have any two clients meet at once. We're sanitizing it before and after you're here, and we're keeping the proper social distancing in place while we meet. So if these are a couple options you might want to pursue, we encourage you to just give us a call on the number that's on the screen or visit our website at cen-wealth.com and just basically you can set up a meeting there. Stay safe. If you have some financial concerns and need to address those, then certainly give us a call. I want to talk to you about the dollar index. Now, this is an index that was created in 1973. What they basically did is took our currency, compared it with the other world currencies, and they baselined it at 100. And then we've been basically tracking it ever since. Now, sometimes it can be up, sometimes it's down. I think at the end of 2019, it was somewhere around 96, 97. What was that saying? Basically saying that our currency relative to the other world currencies was just about the same as it was back in 1973. Now, why is this something that we follow? First of all, when we got a strong dollar, which should be a good thing, right? But when we have a strong dollar, it makes our exports more costly, which hurts our manufacturing. All right, now how's this work, you say? Well, if you've ever traveled abroad, maybe it's Mexico, maybe it's Canada, you'll notice that if our currency relative to that currency, that foreign country you're entering into is stronger or better than their currency, then you get great purchasing power because you get bigger bang for your buck per se, and it makes what you're buying less money. So that's a good thing when you got a strong dollar and you're spending it abroad. But what it does, a strong dollar, like I said, is makes our exports more costly. You'll find if the other currency from the foreign country that's importing goods, they have a competitive advantage because their goods coming into our country are now less expensive. All right, so this again hurts our manufacturing. Now, manufacturing makes up a good 10% of our GDP, so this is something that we want to follow very, very carefully. Now, the other thing that you want to pay attention to when we're looking at the dollar index and why we care about how strong the dollar is all commodities are traded in U.S. dollars. So you'll find that when the dollar is starting to weaken, commodity prices will rise. This is something we definitely want to pay attention to. Now, you'll hear a lot of news, about China and the trade war we find ourselves in and how they're manipulating their currency. That's because Chinese government is in a lot of the public-private enterprises in the country. So they also have the ability to manipulate their own currency. So it gives them a highly competitive advantage when they can play games with their own currency, bringing it down, making their imports into our country less expensive. It kind of gives them a competitive advantage that we don't like them to have. So hopefully this kind of gives you an idea why this is something that we want to follow, why we want to pay attention to it. Hopefully you found some value in it.
I hope you enjoyed those segments. When I was talking about the safe withdrawal rates, it used to be back when 4 or 5% as a general rule was kind of the rule of thumb. But at that time, that was based on a traditional portfolio or a balanced strategy of stocks and bonds. When bond yields were a lot higher and there was a little less volatility. So, now with all the volatility and bond yields being very low, that safe withdrawal rate now is I think considerably less. So, you just got to be careful because you can set that when you start beginning to take income in retirement. But there's one thing, if you heard anything in that segment I was talking about, your number one enemy is you got to stay away from huge volatility. You can deal with low returns for a period of time. Having a year where, it breaks even or loses just a little bit is not going to kill your overall plan. What you want to avoid is those 30, 40, 50% drops in the market. Those are hard to recover from when you're taking money out of the portfolio. If you don't need the money for a while, you can, take the chance of having it grow back. But boy, it's a lot harder to do when you're taking money from that portfolio and you get those big losses. So we have the ability to take any portfolio, get behind it, and actually see how it's done the last 20 years. Most particularly, what was the drawdown or what was the loss as you have it situated today back in 2000 through 2002 when we had that tech bubble burst? What it looked like with the credit crash of 2008, how far did it go down? So if you're somebody that's got a portfolio and you're not quite sure how much risk you're taking on and really would like to know that so it doesn't ruin an income plan you might have, then give us a call. We can do that analysis. We would be happy to share that with you. So now, when you're taking income, there's particular ways you can take the income too that can give you a higher success rate. We've talked about this before. There's a bucket approach. There's the laddered approach. So, if you're somebody that's soon to be retired, you're retired and you're concerned about your income and how you're structured, give us a call. That's something else that we can sit down and kind of show you some options so you can at least raise the likelihood of your plan being a success. And then when I was talking about the U.S. dollar index, one of the concerns I have, today was with this pandemic and all this money that the government is throwing at this. What's that doing to our currency? You can't just keep printing money. We know there's going to be a price to pay for that eventually. I just don't know exactly what that's going to look like and what that's going to do for us as a world trade partner. Right now, a lot of commodities are traded with the U.S. dollar. And, when does the world look at our currency and say, no, we got to do this differently because we don't trust that currency anymore. So again, I don't have a crystal ball. I don't know what that looks like, but I just know that my gut tells me we can't keep printing money that we don't have. So anyway, hopefully you found those segments valuable. In the next segments, I'm going to talk to you about fees and commissions. How do advisors get paid based on what they might be selling, and rental income. So stay tuned.
If you're retired or soon to be retired, let us help you plan to retire well. Centennial Wealth Advisory specializes in retirement planning and has offices in Traverse City, Cadillac, Petoskey, and Gaylord. We'll never pressure anyone to become a client. Our goal is to inform and educate. Simply schedule a meeting at one of our Northern Michigan office locations for a free, no-obligation retirement review.
Hi, in this segment, I want to talk about fees. Listen, understanding how your advisor is getting paid is very, very important. Now, we actually have the tools to take any portfolio, get behind it, and show you exactly what you're paying in fees. But I just want to speak to it because those fees can take different shapes and forms. So for the most part, if you're dealing with an insurance product, whether that be an annuity or be life insurance and the like, most insurance companies pay the advisor a commission. Okay, and they usually get a bigger commission if that annuity is of a longer period of time. Okay, in life insurance, it's usually a percentage of the first year premium. But typically, when you're dealing with an annuity or life insurance or an insurance product, the advisor is getting a commission. There's usually no charge to the client in that environment, no fee to the client. So that can be a good thing. Another way insurance companies can charge is when they have these annuity products. Sometimes they'll come with these riders, whether it be a guaranteed death benefit that's going to be there in case something happens, or a guaranteed income stream that's going to be there. And usually they call these riders because there's additional benefits associated with a contract. And there's typically a rider fee that the insurance company charges. Now, in this particular case, unlike the commissions, that fee is getting charged to you because if there's an investment side to that thing, there's usually that fee is coming off that investment side. So knowing if there's any of those kind of rider fees is going to be important to know. Mutual funds have fees. They have what they call expense ratios. That's the general administrative and research costs that they're having to pay to run that mutual fund, and they pass those costs on to you, and basically it just comes out of the performance. Now that expense ratio, what they're charging you, has to be disclosed in the prospectus. So if you get that annual prospectus from that mutual fund, you can go in there and find out exactly how much you're paying in that fees that's just coming out of your performance. Now, if you have assets under management, this is where a portfolio is actually being managed by an investment company advisor. Typically, how you get charged in that kind of environment is there's a percentage that they charge you on the balance of what's in those accounts. They call it assets under management. Typically, you'll see anywhere from 1%, sometimes up 1.5%. Now, where your funds are held, that's typically with a custodian. You want a custodial relationship because you want that custodian reporting to you everything going on in the account. Okay? in the past, we saw a lot more custodians charging a fee for the trades that were under those accounts. Today, because of competition, a lot of these custodians are now not charging any trading fees. Now, they'll charge you a fee when you exit maybe a qualified account because they have to do a 1099 at the end of the year, but for the most part, no fee. So hopefully you found that valuable. But again, understanding how you're getting charged and what you're paying, very, very important. We here at Centennial Wealth Advisory realize that everyone has been affected by this coronavirus in one way or another. We watch our retirement accounts drop significantly in value, and we have questions. Can I retire in a recession? How will the coronavirus affect my retirement? How do I develop an income stream in a recession? Can I still retire this year? If these are concerns of yours, contact us today for a free initial consultation and learn what you can do now to help you weather the storm. Simply call 888-608-5825 or visit sunwealth.com and let us help you plan to retire well. In this segment, I want to talk to you about rental income. Okay, very, very important. It can be a valuable part of a retirement plan too, as I'll explain. First of all, when you're looking at rental property and you want to know if it'll be good rental income, you're going to have to know some numbers. First of all, you're going to have to calculate what you think is going to be the rent you're going to receive. Okay, so you get a good idea how much rent you can charge, and then you want to get an idea what costs are you going to have to incur: taxes, insurance, whether you pass the utilities on or not. What are those costs going to be? Because what you want to get to is what's called the net benefit. That'd be your gross rental income after all your expenses, and what am I going to get as a net benefit in rent? Okay. The next thing you want to do is what's the amount you're going to be paying for this property, or what if you already own it, what is the fair market value of that property? Okay, so if I get that net rent benefit and make that a yearly number, and then I divide that by the fair market value or purchase price of the rental property I'm trying to purchase, now what you're going to get is a rate of return. Okay, so let's say you get a rate of return of, let's say it ends up being 7-8%. Well, you're going to look at that's going to be very, very good rate of return, right? How much risk do I got to take in the market just to get maybe that same number? So that's going to be valuable to know. So when you're looking at rental property, please look at it first that way. The other thing you get with rental property is if it gives you a good rate of return, we're not even factoring in appreciation. If that property goes up in value, you can add that to your rate of return. So let's just assume you say 1%, 2%, appreciation. Now that 7% is 8-9%. So that's a good number to know. The other nice thing about rentals is you get to depreciate them, over a number of years. Typically, I'll find with rental property that depreciation is enough to offset the net rent. So in a lot of cases, you're paying very little or no taxes on that income as you own it. Now, the bad thing about depreciation is when you depreciate it from a tax standpoint, now your basis is lower, and later on when you sell it, you've got this huge capital gain because now all that depreciation has to be recaptured as basically income. But if you have that rental property and you pass it on as an inheritance, guess what? They get stepped up basis on it, and then no tax ever had to be paid on it. The other nice thing about rental income is it's inflationary. You get to raise rent, so as costs go up, you get to raise the rent. So if you've got it as a retirement instrument, it's going to be a good income source for a long, long time. Now, rentals can be a headache. You can pass that headache on to a manager too. Typically, they'll take anywhere from 15-20%, but if you don't want that headache, could be valuable. Hopefully, you found this segment valuable. If you have any questions about this, give me a call.
So in that segment that I was talking about fees and commissions, a lot of people don't care that their advisor gets paid. A lot of times people just want to know where they get paid, right? And how much that is. This is really important because what a person's trying to really ascertain is that are there any conflicts of interest here? Am I recommending a certain product over another one because I might get paid more? Well, wouldn't that be nice to know if that was the case ahead of time, right? Because that advisor, that person selling whatever they're selling, would have to give you a good explanation as to, other than the fee being higher, why they want you in that particular financial instrument, right? So knowing how the advisor gets paid, I think people really, like to know. If you're somebody that's out there that, has these accounts and you don't know how your advisor is getting paid, then, let us take a look at it for you. We'll tell you exactly how that advisor got paid so you can make sure that there weren't any conflicts of interest regarding that when maybe you purchased or bought into that program. So let us know if that's something we can help with. And then when I was talking about rental income, rental income can be great in retirement. I talked about it. It can be inflationary. If I'm charging, and use a round number, let's say I'm charging $1,200 a month for rent. And with inflation, I know that, in a year or two, I can raise that to $1,250 or $1,300 a month. Well, now I'm kind of building in something inflationary that can grow with inflation. So I'm not going to lose any purchasing power. So rentals can be great in that regard. Where I can't stress enough is that when you get involved in rental property, the best kind of rental property to have when you're in retirement is paid for rental property, right? The last thing I want to do is be too leveraged. Don't go out and buy rental property when you're getting close to retirement and you've got it leveraged, meaning basically all your income's going to payments. It's much better to be getting involved in rental property when you're younger, so that by the time you get to retirement, they're fully paid for. Now you have all that net rent benefit coming to you that you can actually use for income. So great, they're great for long-term investments. Maybe not so great if you're getting soon to be retired and you want to get into those, unless you've got money that's not being too productive sitting on the sidelines. Maybe that could go towards rental properties as well, where you can kind of produce an income. So do I think you want to have all your eggs in one basket? Probably not, but to have some money invested, some money maybe in some rental property, stands to reason, might be wise. So maybe that helped you or not. We get asked that a lot of times with rental property, should I or shouldn't I? And I thought it'd be valuable to get that out so people can kind of take a look at it from a kind of different angle. So anyway, I want to talk about life insurance next, so stay tuned.
Your grandchildren are precious to you. They are your life. This is your time to have that special relationship. Taking care of yourself is taking care of them. Centennial Wealth Advisory is offering a free, no-obligation retirement review to make sure you don't run out of money during your retirement. Centennial Wealth Advisory. Your best is yet to come.
In this segment, I want to talk about life insurance. Now, when I was a young man, had not accumulated a lot of assets, I had 3 kids at home, and I was the sole breadwinner, I found having life insurance very, very important. But as I got older, as I acquired some assets, my kids are now grown up, they're having their own kids now. Did I find that life insurance was as valuable as it was when I was younger? Maybe not. But I want to give you some ideas where life insurance can be valuable in retirement planning, especially in the latter years. First of all, when it comes to life insurance, a lot of people will be paying this premium, and they'll come in and they'll say, Larry, I'm not seeing much value in maybe having this. I'm paying this premium. Maybe we could have that being going to something different, And what I'll ask them is simply this, what do you need that life insurance for? Is there any need for it at all? Because when you're looking at life insurance, you have to look at it like any other kind of insurance. I have house insurance in case my house goes on fire and I lose it, right? I'm going to want that contingency taken care of. I get long-term care insurance because if I fear I might go into a nursing home, I want to make sure I have the insurance for that. I have car insurance in case I have an accident. I have life insurance in case something happened to me. You know, does my family need any lump sum of money in any way? I want to assess it simply that way. If I have sufficient assets and I don't really need that anymore, then I would dare say we probably don't need to pay the premiums on it. There's some areas where you might need it. If maybe one of the spouses has a pension and is going to lose some of that pension amount, all or some, if something happened to that spouse, then, or maybe you know with Social Security you're going to lose the lesser of the two, having a lump sum to replace that income could be important in those latter years if we thought that could happen. We can use life insurance in an IRA exit strategy. Let's say I've got a big lump sum of IRA money, and I'm in such a tax bracket that I can't buy out Uncle Sam while we're both living. But what if that first spouse dies and the second spouse, the surviving spouse, has this lump sum money from life insurance that they can use to buy out Uncle Sam out of the IRA and then forever have tax-free income from then on? That could potentially be valuable. Again, any time I could see where I might need a lump sum of cash for any reason upon my death, then I'm going to want that life insurance. Now, you may not know this, but a lot of life insurance today, the death benefit can now be used for long-term care. So sometimes it might, if you still find life insurance valuable and you want it, you might be apt to maybe want to get some recent quotes because that death benefit can be used for that long-term care. Could be valuable. So hopefully this gives you some ideas where life insurance can be used in your retirement planning. Hopefully you found it valuable.
Hi, welcome back. Hopefully you saw some things there that you might find useful. Like I said, life insurance when you're young, great need, and then all of a sudden you get older and you go, do I need this policy anymore? Well, like I said, if there's anything you might need a big lump sum of cash for, yeah, possibly. So one thing I didn't talk about in that segment is, when you need liquidity. For example, I see these people put a family cottage in the trust, and they want that cottage to be there for the family members for a long time coming, right? But there's no cash to pay the operating costs of that cottage, taxes, insurance, things of that nature. Well, there's where life insurance can be maybe valuable. You pass away, the cash goes into the trust. Now they've got sufficient liquidity to pay all those costs for the family cottage going forward. Sometimes people just want to leave a larger legacy. They got an income plan, they're using their funds for retirement. They know there's going to be something left, but if they want to, make sure they know how much is going to be left behind, they can have some, a policy that's there just for that. So sometimes it's just leaving a legacy. You want to, leave your family members very well. And so hopefully they gave you a lot of reasons why you might want to have life insurance. Folks, we talked about a lot of things today. Just remember that, at Centennial Wealth, we do income planning, tax planning, estate planning, Medicare, supplement healthcare, planning, and along with investment management. So there's a number of things we're involved in and helping clients with. So if you're somebody out there that could use, some good advice, we'd be glad to help you. So just give us a call. Thank you for joining us this week. We'll see you next week.